Understanding rebalancing, a guide to maintaining your investment portfolio. Rebalancing is a critical concept in portfolio management, aimed at maintaining an investor's desired asset allocation and risk tolerance over time. As the market fluctuates, asset allocation levels can deviate from an investor's original plan, necessitating periodic adjustments to realign with intended investment goals. This comprehensive guide explores the principles, strategies, advantages, disadvantages, and the overall significance of rebalancing in portfolio management. What is rebalancing? Rebalancing refers to the process of adjusting a portfolio's asset allocation back to predefined levels as stipulated by an investor's strategy. These allocations are typically designed to align with the investor's risk tolerance and expected returns. The process of rebalancing. As market dynamics shift, certain assets within a portfolio may outperform others, altering the initial allocation. For example, consider a portfolio with an original target of 50% stocks and 50% bonds. If stocks appreciate significantly, their allocation might rise to 70%. To rebalance, an investor would sell some stocks and use those profits to buy bonds, restoring the 50% to 50% target allocation. Key takeaways. 1. Rebalancing helps manage risk. It ensures that investors do not inadvertently take on more risk than they are comfortable with. 2. It is essential for profit-taking. Regular rebalancing allows for capturing gains from outperforming assets and reallocating to areas expected to grow. 3. Various strategies exist. Investors have options such as calendar rebalancing, constant mix, and smart beta approaches. Why rebalance? Over time, market conditions and the economic landscape evolve, which can lead an investor to adjust their portfolio for several reasons. Changing financial needs. An investor approaching retirement might favor lower-risk assets compared to when they were younger and potentially seeking higher returns. Risk management. Regular rebalancing helps manage the level of risk an investor is exposed to within their portfolio. Opportunity seizing. Selling high-performing assets to invest in lower-performing ones can help capture gains while taking advantage of potential future growth. It is important to note that rebalancing does not imply that the investor needs to maintain an even distribution of assets like a 50% to 50% split. The target allocation varies depending on individual goals. When to rebalance? While there is no universally mandated schedule for rebalancing, it is advisable for investors to review their allocations at least annually. Ignoring this step can lead to imbalances that introduce excessive risk. By maintaining a regular rebalancing schedule, investors can strategically sell high and buy low, leveraging market dynamics to their advantage. Types of rebalancing strategies. 1. Calendar rebalancing. Description: adjusting the portfolio at fixed intervals, such as annually or quarterly. Advantages: simplicity and less frequent trading minimize costs. Disadvantages: less responsive to market shifts, significant market changes may require earlier adjustments. 2. Constant mix rebalancing. Description: maintaining a target percentage for asset classes with allowable fluctuation bands, e.g., a 30% to 40% tolerance range. Advantages: more responsive to changes, maintaining strategic asset allocations. Disadvantages: more frequent buying and selling increase transaction costs. 3. Constant proportion portfolio insurance, CPPI. Description: a strategy that allows for greater allocation to risky assets based on a predefined floor value for the portfolio. Advantages: provides a dynamic approach to risk management while seeking potential upsides. Disadvantages: can be complex and demanding in terms of monitoring and adjustments. 4. Smart beta rebalancing. Description: index-based rebalancing that uses various performance criteria beyond market capitalization to allocate assets. Advantages: reduces reliance on market inefficiencies while maintaining systematic analysis. Disadvantages: still requires a degree of oversight and discipline. Examples of rebalancing. Rebalancing retirement accounts. Investors may choose to rebalance their retirement portfolios as they get closer to retirement age to shift from high-risk equities to safer fixed-income securities. Rebalancing for diversification. If one stock in a portfolio significantly outperforms others, reallocating some funds from that stock to other investments can help mitigate risk by ensuring better diversification. Advantages and disadvantages of rebalancing. Advantages. Alignment with financial goals helps maintain the intended risk-return profile of the portfolio. Disciplined approach enables a systematic investment strategy that is less influenced by emotions. Adaptability can be modified as investors' financial circumstances or goals change. Disadvantages. Transaction costs. Rebalancing may result in fees that can reduce overall gains. Missed opportunities. Selling assets that have appreciated greatly can mean missing out on further profits if they continue to increase in value. Time and knowledge requirement. Effective rebalancing necessitates investment knowledge and experience. Conclusion. Understanding and effectively implementing portfolio rebalancing is crucial for achieving investment objectives while managing associated risks. By aligning asset allocations with individual financial goals, risk tolerance, and market conditions, investors can maintain a disciplined approach to wealth management. Whether done independently or through the guidance of a financial advisor, rebalancing remains a fundamental element in the investment process, ensuring a tailored alignment with evolving market landscapes.